In March of this year, the Federal Reserve's Federal Open Market Committee lowered its economic growth forecast while raising its inflation outlook, sparking some to speculate that stagflation is about to hit the economy. What are the chances of stagflation, and what should investors do to protect themselves? With all the recent disruptive talk about tariffs and trade wars, the Federal Reserve believes that the economic uncertainty has increased, and as a result, they've lowered their economic growth forecast from 2.1% to 1.7%, and increased their inflation forecast from 2.5% to 2.7%. This is what has sparked talk about stagflation risks increasing for the U.S. economy. Stagflation is where a bad economy is coupled with high inflation. This is opposite of the typical relationship where a bad economy is usually coupled with low inflation. Stagflation is very tough to beat, and fortunately is also very rare. In fact, it has only happened once during my lifetime. For those of us who lived in the 1970s, we remember how hard it was to get a job when we graduated college because the economy had shrunk by 2% and unemployment had skyrocketed to over 9%. Inflation was over 14%. And remember the long lines to buy gas? But even if the Fed's forecasts are right, 1.7% economic growth is a long way from minus 2% growth. And 2.7% inflation is a long way from 14% inflation. So while the risk for stagflation is increasing, it is currently low. But if you're worried about it, there is an insurance policy that you can get to protect your portfolio from stagflation risks, and that's gold. During the stagflation of the 1970s, cash lost value due to inflation, and both stocks and bonds declined in value. But gold was one of the few investment bright spots. It went from $77 an ounce to $678 an ounce. What does this have to do with American investors, especially those investing for their retirement? Well, with the greater economic uncertainty right now, most portfolios and retirements are still almost exclusively made up of cash, stocks, and bonds. Yet, over the last year, gold has risen from $1,800 an ounce to over $3,000 an ounce today. So regardless of what's in your investment or retirement portfolio, it helps to diversify into gold to lessen your risk, especially with so much uncertainty. One way to add precious metals to your retirement portfolio is through a precious metal IRA. I have one, and mine is from U.S. Money Reserve.